I'm going to talk about FOMC event risk. A lot of the things might apply to other forms of event risk also. So it's not news to anyone that FOMC announcements are important and major pieces of information for financial markets. So here's a few news clips. We often see prices spiking upwards, spiking downwards. Sometimes nothing happens. Sometimes things happen immediately. Sometimes things happen with a little bit of a lag. And these announcements are, I think, important directly for financial market participants, but they've been increasingly important for academics who are trying to understand the nature of monetary policy, how monetary policy gets into the real economy through financial markets. And so today I'm largely going to talk about measurement issues associated with extracting estimates of FOMC effects from options markets. If this presentation had been on Friday, it would have been better because I could have uploaded information from tomorrow's Fed. During elections, Fed meetings go from Tuesday, Wednesday during election years, from Tuesday, Wednesday to Wednesday, Thursday. And in another sort of timing of the world, there'd be a Fed going on right now. And so we could almost watch it. We could watch it live. This is some news clips from what happened in September. And one of the interesting things was, if you look at this lower right graph, there's a commentary that this was the most uncertain FOMC meeting on record in September. And at the time, they didn't know if the Fed was going to go 25 or 50. They ended up going 50. And normally, the Fed telegraphs things pretty clearly. And in this case, they didn't. It seems like there was more uncertainty than usual. So the goal of the paper is to characterize FOMC event risk. As I mentioned, FOMC events are important for a number of applications, certainly for market participants in economics and in finance. So if you think of policy announcements, when the Fed announces what they've done, and then a little bit about why they did it, and then they hold a press conference explaining it in greater depth. Okay? And the shocks that these announcements generate are useful in a range of applications. So it's the primary mechanism for policy, economic policy and forecast to affect markets and the macroeconomy, at least in an identifiable way, where we can kind of see it in real time. Certainly other policies happen, but the news about those policies may filter out in very small amounts over time, so we're not able to cleanly measure them. Macroeconomics utilizes shock responses or shocks extracted from asset price responses around announcements to a very high degree for use in a number of different contexts, both for shorter term things and then also for putting them in vector autoregressions for longer term analyses of the reaction of the economy to monetary policy shocks. And you can see this from the Bernanke and Kuttner quote here: the most direct and immediate effects of monetary policy actions are on financial markets. Finance has recently, well, I think at some level, empirically, understanding announcement effects have always been important, certainly back to the 80s or 1990s. I think increasingly, there's a big focus on the FOMC for many reasons. Maybe the importance of monetary policy is greater now than it was before, but in part because research has uncovered a lot of interesting patterns in what happens around FOMC announcements. So there's this really influential Luca and Monk paper where they identify, and I'll talk more about this later, these very strong asset price drifts that appear to occur actually prior to the FOMC. Finance researchers are also using monetary policy shocks extracted from financial markets' response to the FOMC in order to understand aggregate asset price movements in a range of markets, as well as the cross-section of asset prices. And then there's a new sort of class of macro finance models incorporating event risk explicitly. So instead of saying we have some general shocks here and we're going to have a model for them, evolving, a diffusion specification evolving over time, now we're going to take the timing explicitly take into account the timing and the fact that it generates a sort of discrete shift or a jump in the underlying asset prices. And this is where I think, one of our main contributions is going to be in that we're going to provide direct estimates of FOMC event risk. We'll also do it for other macro announcements, in contrast to indirect estimates that have been previously used. And these are the exact things that go into those asset pricing models. Okay, so I think we can basically transport our estimates directly into these. And that's always nice when writing down a model where you don't have to have, I think, rather crude proxies for the things in your models, where you can almost observe them perfectly. So in the next 45 minutes or so, we are going to identify, estimate, and characterize FOMC event risk. And when I say FOMC event risk, what I mean by that is the predictable volatility generated by FOMC events. So think just prior to the announcement, there's a variance associated with the announcement. And because of that, we know that markets are going to be more volatile for a period of time after the announcement. Okay. And our goal is going to be able to estimate this. You can't estimate it from the underlying time series because you effectively get one option. If you assume that risk from one Federal Reserve meeting to the next changes over time, if you were just to use realized returns, you see one set of, say, realized volatilities or a jump at the FOMC. So you have one observation to estimate one parameter. Options provide an alternative where, due to the rich information embedded in options, we can extract information about the FOMC event risk from the cross-section and the term structure of option prices. So methodologically, to do this, we're going to estimate FOMC event risk combining three ingredients. So the first is high-quality intraday option quotes from 2012 to 2023. I think there's an increasing usage of these. I think in part just as quality of data has gotten better, but certainly also more recently because of the increase in strikes that are available, or strikes and expirations that are available in things like S&P 500 options. We're going to use models to filter out things that can confound FOMC event risk. Okay, so the models are going to incorporate predictably timed event risk, say FOMC or a macro announcement, but also stochastic volatility, the normal crash risk that we need to embed in our models. And we're also going to incorporate intraday periodicity. For anybody who's seen a prior version of that, we did not have that earlier. We've been working hard to incorporate that, and we have been a little bit surprised at how important that is. And I'll talk a little bit about why it's important and why it may be more important than certainly I thought it was. And combining the data and the models, we're going to calibrate the models to estimate FOMC event risk for each meeting, extract out estimates that then we can use. Given these estimates, I'm going to just report a number of different empirical results. So first will be raw summaries of the estimates, what they look like, how big they are, how much they vary over time, and what they correlate with. We're going to show that our estimates are highly predictive of future realized volatility across the announcement, which is really important because that tells us that the risk-neutral measure stuff we're picking up from options is telling us a lot about what actually is going to happen in the real world. I'll spend probably the largest single chunk of time talking about how FOMC event risk is priced, ex ante, and resolved. Okay, and this gets to some of these, the Luca and Monk patterns of how there's been drifts in equity returns ex ante, and models and theories tell us that maybe resolution of the FOMC event risk uncertainty is the cause of those underlying drifts. We're also going to we're going to be able to disaggregate total FOMC event risk into announcement risk when they release the statement at 2 p.m. and press conference risk, which starts at 2:30 and typically runs till about 3 o'clock. So we're going to be able to disaggregate those out. And then I don't know if I'll have time, but we've also estimated event risk for various macro announcements and created a macro risk index. One thing I forgot to mention is we'll also carefully characterize event risk premia, and we'll find that there's a large FOMC event risk premium, which is largely absent from other macro announcements. So there's something special about the FOMC that we will see. Okay. So we're not coming from left field here. There's a lot of existing work on option pricing with predictable event risk. And I think many of us have seen these patterns in many different settings. So what do we know in general about predictable event risk and option prices? So first, there's very strong signatures of predictably timed event risk in option markets. So the first one is that implied volatility tends to increase non-linearly prior to the event. Okay, so as we get for fixed maturity of options, as we move into the event, implied volatilities increase. Okay, effectively, as the event becomes relatively more important, we can see it more clearly. The term structure of implied volatility, think of at-the-money implied volatility for increasing maturities is downward sloping prior to the event. So 1 day, 1 week implied volatility is higher than, say, 1 month or 3 month implied volatility. And then the third property is post-event, after the news has come out, implied volatility drops as the event has sort of passed and uncertainty has resolved. Okay, and so those 3 characteristics or signatures of event risk are very clear. And there's many papers that that document these effects in various settings for various markets. It's easiest to see this for earnings announcements, and the reason is the volatility generated by an individual stock earnings announcement is on the order of 1 week or 2 weeks worth of realized volatility. Okay, as we'll see later, for the FOMC, the amount of uncertainty generated by an announcement is on the order of 1 day. Okay, and so earnings announcements are just much bigger than FOMC. That also means we're going to have to be a little more careful about the tools we use in order to identify it, because it's easier to confound FOMC event risk than it is earnings announcement risk. Basically, almost any crude estimator will work really well for earnings announcement, and that's not going to be true for FOMC event risk. So here's a few pictures, just giving you a sense of the magnitudes and what the pictures look like. So here's a plot of the term structure of S&P 500 index implied volatility prior to the FOMC, and you see this very striking declining term structure. Okay, now you notice that the sort of magnitudes of the decline, the overall level of volatility and the magnitudes of the decline vary across announcements. That could be due to the fact that regular volatility varies across announcements, but it'll mostly be due, or large part due, to the fact that event risk varies across announcements. So some Fed meetings are more important or riskier than others are. And this was the second characteristic here, that the term structure of implied volatility is downward sloping prior to the announcement. The third property is that at the money or implied volatility drops after the FOMC. So here's a picture of intraday implied volatility for fixed maturities across the FOMC. So the gray vertical line is the FOMC. Okay, and you can see different announcements have different levels of uncertainty. In all cases, they drop. Sometimes they drop by more, and sometimes they're higher or lower prior to the announcement. Now, they don't fully drop immediately for 2 reasons. One, there is some sort of digestion time, but secondly, for most of the sample, we have press conferences. Okay, and so that's why you don't see just a single discrete shift downward. Okay, you can see here the effects. These are for different maturities. So the maturities, the shorter term maturities, are more sensitive to the FOMC shock. So you can see the decrease here. This is on September 17th. The decrease for the 18 expiration or the 20 expiration is more than the decrease for the October expirations. And that's going to be a general point. If you want to see this, looking at shorter dated options is going to be easier to see it because there's less other noise there. Okay, so if you looked at a month, you have 29 non-FOMC days and 1 FOMC day to pull that FOMC effect out. If you have a 2-day option, kind of have 1 non-FOMC day and 1 FOMC day. So it's a lot easier to identify and see it. It's more clear in the data. So in order to think through the effect of event risk on option prices, let's look at a simple model, an extension of the Black-Scholes model to incorporate predictably timed events. So MT here is a counting process that just counts the number of macroeconomic announcements. And then the jump size at an announcement is given by this random variable Z. And again, the announcements are fully predictable. So there's no randomness in this. It's just a counting process that goes up by 1 at announcements. And then the other component is just the usual geometric Brownian motion component. We assume jump sizes are normally distributed. That's convenient because there's a single parameter to estimate. We've considered extensions, and we can talk about that later if we have time. Given this specification, since all of the shocks are log normal, the Black-Scholes pricing model applies, but with a modified volatility input. So instead of implied vol on the left-hand side here being sigma squared, it's sigma squared plus this component with event risk. Okay, and this is what this component in the Black-Scholes setting generates all the time variation we saw. Implied vols go up prior to the announcement, term structures downward sloping, and vols drop immediately afterwards. Okay, so this simple model generates all the main patterns. And the point of this then is just to explain that, or to note that all these strong patterns we see is simply because of the predictable timing. Okay? And you'll in fact see those in any model. If you add in stochastic volatility or jumps or whatever else you want, those effects will still be there in these more general models. And it's really because our normal shocks aren't predictably timed. They're in fact unpredictable, whether it's Poisson shocks or Brownian motions or time varying volatility. So there's just a very separate or a different effect when you have predictable events. So an obvious question is, okay, we have this model and we have a single parameter here, which is the event volatility. How do we estimate it? So in prior work that I had done with Norman and Andreas, we came up with event risk estimators. And what we found is for earnings announcements, you can use these really simple estimators. So you calculate implied variance. This is sort of Black-Scholes implied variance for one maturity, an option maturing at time t1. You do it for another option maturing at time 2. You normalize these two, and it's sort of two equations and two unknowns, and you can back out both the diffusive volatility and the event risk volatility. And that worked great, and it continues to work great for earnings announcements. And the reason is, for earnings, this component is so much bigger than this component. Okay, and because of that, even if you have like a 1-month option or a 2 or 3 week option, you can see that very easily. Now, for index options, we're fortunate we have all these extra maturities now. So additional Fridays that liquidly trade, Monday and Wednesdays, and Tuesdays and Thursdays. And I'm starting here in 2012 because that's when our sample starts. So we now have a rich term structure to identify events. And as I mentioned, shorter maturity options load more heavily than longer maturity options. So in principle, you can use something like this, and it actually doesn't work that badly. Most of the time, you sort of get the right answer or close to the right answer. The problem with these estimators is it ignores 4 potential confounders. First, there could be other macroeconomic events. So, typically 2 or 3 times a year, the Fed announces at Wednesday at 2, but earlier that Wednesday, say at 8:30, there was a CPI announcement. Okay, and that confounds that. Now, you could control for that a little bit using daily data, intraday data, but in general, there's other announcements, and you could also have other announcements in the days following the Fed, okay, and that can confound that. The second and third ones are sort of obvious. You have time varying volatility. So this sigma squared component is different, and it's mean reverting. And so it appears as at different levels for different maturities, but it's just mean reverting stochastic volatility. The same is true for crash risks. And then, as I mentioned earlier, intraday periodicity turns out to be surprisingly important, especially in the more recent samples when we're using the very short-dated options, okay, or where we have more short-dated options. So instead of just a Wednesday, we always now have a Monday, Tuesday, Wednesday, Thursday, and Friday expiration. And because FOMC event risk is smaller than earnings risk, we need to account for these other factors. Okay, so I don't think there's any discussion or any question probably about how other confounding macro events can create problems, or time varying volatility, crash risk. What about periodicity? Okay, so we've known for a long time that intraday periodicity is important, or it's a strong feature of financial markets. So volatility is lower overnight than during the day in general. And then we see this common U-shaped intraday periodicity. Okay, vol's higher at the open than the close, although the close tends to be a little higher than the open. And then during the middle of the day, it's kind of quiet. And you can see the Fed's happening right around here. And so the Fed happens right before volatility spikes up in a predictable way. And the reason periodicity has important impacts on options and implied volatility is that volatility per unit time is no longer constant. Okay, so when you do things like annualized volatility, you're going to generate distinct periodicities because economic time is different than calendar time. So overnight periods don't have the same per unit volatility as daytime periods. The same is true for weekends. Okay, and this is, I don't think, a surprise to anyone who's active in here. I have to admit, the magnitudes were a surprise to me. Okay, and it's easiest to see from the VIX index, which has a strong weekend effect. So this is from a paper, a 2016 paper. There's a more recent paper by Torben and co-authors who sort of refine this and examine how big of an effect it is when we start having more and more strikes. And it is attenuated to some extent, but it's always there. And you'll see why even in 0 and 1 DT data, it's going to be there. Okay, so normally we see the VIX spikes up over the weekend and then predictably goes down all week long. And that's just because of weekend effects. If you think of having fixed Friday maturities, as you're rolling through, as the VIX is sort of rolling through time, you may be losing high vol periods like a weekend, and you replace them, relatively long period of time periods like weekends, and you're replacing them with other periods of time that have different volatilities. Okay, and what this does is it really, when you look at implied volatilities, these things are moving around predictably, but unrelated to FOMC event risk. Okay, so FOMC event risk and macro announcements are going to have this sort of periodic effect. There's going to be a periodic effect due to weekends, overnight periods, and time of the day, and we have to be able to separate these two out. So here's a picture of the intraday periodicity for short-dated options. And I was surprised, to be honest, at how big it was. Okay, so these are actual, just observed option prices. These are VIX-like portfolios held, constructed sort of in real time into a fixed maturity. So the red line is here on it for a 0 DTE. This is an annualized VIX-like portfolio into the close. And you can see on an annualized basis, this goes up. And if we think of this as like variance, this is due to the fact that variance at the close is higher than variance at the open. And then you also see the opposite pattern for 1 DTs and 2 DTs. Okay, as overnight periods have lower volatility than during the day. So as you go through the day, it looks like volatility is declining, but this is just due to the fact that there's a periodic component because the periods of time during the day have higher volatility than overnight. And so then the annualized volatilities fall. So this is going to look a lot like some of the effects we see from event risk. So this is something we're going to have to take into account. And we've just recently got some results off the presses to do this. Okay, so how do we take this into account? So you can think of this as a Black-Scholes model now extended to incorporate intraday periodicity as well as macro announcements. Okay, so for intuition, we have Black-Scholes plus FOMC risk plus periodicity now. And Black-Scholes implied volatility, assuming a single announcement, now looks like this. And to the extent the time to maturity is not long, so as we move to very short periods of time, this H function becomes really important. As you roll from like 1 DTE, say 4 o'clock the day prior to a Fed, as you roll through time, you're consuming or passing or resolving periods that have very different volatilities. Okay, and so depending on the magnitudes of H, Black-Scholes implied volatilities will have strong periodic components, unrelated to the FOMC, and that's just these pictures here. Okay, and these can impact, pollute, bias FOMC estimators if you don't account for them. Okay, so how do we account for them? So we are going to develop the analytics to price options with periodic components, both in theory and empirically via characteristic function inversion methods. Then we will calibrate Bates-style SVJ models augmented to include intraday periodicity, other macro announcements, and of course, SV and crash risks, so that we can sort of filter out all this other stuff that we know is important to get a clean estimate of FOMC risk. And then we're going to combine sort of the theoretical model, empirical calibrations with very high quality intraday data from Refinitiv, high quality quote data. Okay. So think every FOMC, we're going to calibrate a Bates model, taking into account these other factors, okay, in order to purge our FOMC effects of these other things, okay, to get a clean measure. And this is what they look like. Okay, so again, this is from 2012 to 2023. So on average, what are the units? They're about 85 basis points, a little bit less than 1% is the average FOMC event risk. Okay, these things, of course, are highly significant. Estimating them from options, there's a lot of information. But as you can see, for different samples, they do seem to vary a bit over time, and I'll show you a little bit more on that later. So if you look at the lower end of the range to the upper end, it varies by a factor of about 6. First question is, well, can 1% equity shocks really be so important for macroeconomic outcomes? So if you think of the importance that macroeconomists place on these announcements, I was honestly a little bit surprised they weren't bigger. I guess we kind of know that from the realized volatility literature. But it does beg the question of, if we think these things are driving monetary policy, how can it be that a 1% equity shock, which is equivalent to a sort of a normal daily S&P index return variability, how can that really change macroeconomic outcomes? We had one FOMC with a 0 estimated vol, which was the contested 2020 election. In general, if there's events that we don't take into account, they can pollute our estimates. We can take those into account, but it's basically the 2020 election swamps everything afterwards. So imagine if we were sitting here today and we had a highly contested election, what the Fed does tomorrow just doesn't matter anymore. And so it's basically impossible to back out the effects. The variation here, say a factor of 6 over time, is much higher than we see from something like the VIX. So the ratio of kind of like a extreme VIX to a extremely high to extremely low VIX is about 3. So think of 10 versus 30 or so. And so FOMC risk is varying more. Part of that's because the VIX averages over a longer time period. To what extent does our measure correlate with other observable things? Well, if you correlate it with the VIX, it's certainly significantly correlated, but it's modestly correlated. And what this says is there's a lot of other stuff going on at FOMC meetings unrelated to the overall level of market volatility. Okay, so the event risk of the FOMC on the S&P is very different, or substantially different than sort of the overall level of volatility. So it's not the case that if you just take the VIX as a proxy, you're going to pick up FOMC risk. You'll pick up a component of it, but you're going to miss about half of it. And interesting for periods like 2020 to 2023, when we both have more accurate estimators because we have more maturities, and it's sort of economically a more interesting time, you can see the correlation goes down. So there's this sort of a bit of a disconnect between the VIX and what's going on with the FOMC, even though they're both measuring S&P 500 index vol. Here's a picture of the time series of these during our sample, and you can see a couple things. So the black ones are ones without press conferences. The gray ones are ones with press conferences. Starting in 2019, we have a press conference every meeting. And you can see over here, in general, ones with press conferences have more risk or more volatility, event risk, than ones without. And maybe that's the point. The Fed wants to convey more information to markets. That's why they have a press conference. And then you can also see this sort of period of macroeconomic stability here, 2017, 2018, 2019. Interestingly, when COVID spikes up at first, FOMC event risk doesn't go up much. And if you think about it, I think that's quite intuitive. Everybody knew what the Fed was doing. There was no uncertainty. They were going to stimulate to the maximal effect, and they weren't going to change what they did, which is probably why, in part, we had this period here where once inflation got high, there was a lot of FOMC uncertainty. I think market participants and financial markets didn't quite know how the Fed was going to be able to get this under control, and maybe this is something still going on. So recent FOMC event risk is much higher than we've seen in the past. And certainly even higher than we have when we have higher macroeconomic volatility, like during COVID. So I think this is a second lesson, that macro vol and FOMC vol are not that highly correlated. We're able to decompose total FOMC risk into statement risk and press conference risk. And think about, in order to see how we do that, think about the following. So prior to the announcement, we just see that there's going to be excess volatility. We only have an option maturing, say, either at the close on Wednesday or Thursday or Friday. And so at 2 p.m., you just know that there's going to be excessive volatility until the close. However, after 2:15, say, we will have resolved the FOMC statement risk, and now what we have left is FOMC press conference risk. So you can think of decomposing the total risk into a statement component and a press conference component. And what we do is separate these out by estimating the sum of the two prior to the FOMC. Think 1:55 p.m. on a normal Fed day, or 1:50, sorry, and then we'll re-estimate the model at 2:20. So after the statement's out, but before the press conference. Okay, and that will allow us to identify this second component, which would be the press conference risk. Okay, and then we can compare the two and look at, for instance, the ratio of press conference volatility or variance to ex-ante total FOMC volatility or variance, to get a sense of how much of the variance is due to the statement and how much of it is due to the press conference. And here's the results that we get for that. So you see that on average, we have about 68 basis points of vol for FOMCs without press conferences. And then we have much higher volatility for FOMCs with press conference. Okay, and if you break down how much of the variance is due to the press conference versus the statement, you end up with a little bit over 50%, about 2/3. So 2/3 of the variance of the total FOMC event risk is due to the press conference. And I guess at first that surprised me, but I think that may have been the whole point of having press conferences, is that the Fed wants to convey more information. They know that a 2 or 3 paragraph statement doesn't really convey enough information. And so the information of the total amount of information, they're going to give you more information. That's because meetings with press conferences have higher volatility than meetings without, 0.98 versus 0.68. But then it's really not the statement. It's more the nuance from the press conference. Okay, and while these things vary a little bit over time, they're pretty relatively constant throughout the sample. So, around 2/3, certainly more than half, and less than 3/4 of total volatility is due to the press conference. An obvious question is, whenever you extract things from options, to what extent are the things you're extracting from options telling you about risk premiums, volatility risk premiums, and to what extent are they telling you something about what's actually going to happen under the P measure in terms of market expectations of actual realized volatility? We know that implied volatilities provide some information about future realized volatility. There's a large literature doing that. And this is easy for us to evaluate in our setting. We can take ex-ante measures of event risk, and then easy to measure ex-post variability. And We think this provides a good test both of the model and of our estimation procedure. So if there's a high degree of predictability, seems like our model and our estimation procedure is capturing the effects quite well. And if the FOMC event risk predicts realized variance, then this second moment of monetary policy shocks are in fact highly predictable. Okay, so market participants should know ex ante how much news is coming ex post. So what do? We just run some simple, effectively, regressions and correlations between realized FOMC volatility, say from 2 to 230, 2 to 330, on our ex ante estimates, as well as other estimates of volatility. Okay. And I think it's easiest to see just from some graphs of what's going on. So here's different measures. This is, from 5 minutes before to 30 minutes after realized volatility. This side is realized variance, so kind of blow up the outliers a little bit. And in all cases, you see very high correlations between our ex ante option-based estimates and what actually happened ex post. Okay, so I would argue these are very high correlations, and certainly much higher than normal implied realized correlations that we see just extracting out implied volatility and forecasting realized volatility in the days afterwards. We can run some standard regressions, and here we include, think of our event risk estimators, and we're going to add in spot vol, sort of the VT backed out from the Bates model, as well as some that's option extracted spot vol. And then you can think of this as like a past realized time series based estimate. I think you'd probably get the same thing if you just used lagged realized vol, but this was from a Garch model. And what you see in all cases is the event risk estimator has a larger coefficient, is more significant than these others, although, of course, the event risk doesn't fully capture everything. There might be a little bit of residual predictability, but that's because if you think of the 90 minutes after an FOMC event, you're getting some FOMC event shock, but then you're also getting some diffusive volatility. So you would expect that a measure of diffusive volatility would also be significant here. So this is effectively what we expect. And you can see that other measures of volatility are insignificant at high frequencies, where it's mostly the jump from the FOMC announcement. And then as you go to longer periods, it sort of has more and more diffusive volatility. So that stuff kind of, both the coefficients increase and their statistical significance increase, exactly what I would have expected. Our S&P 500 index event risk, similarly, not quite the same magnitudes, but also predicts realized variance in the bond market, which says we're not picking up something peculiar to equities. We're actually picking up fundamental shocks generated by the FOMC. So you can imagine the FOMC shock is the thing we're measuring is a combination of the FOMC shock plus the sensitivity of equity markets to that shock. And what this shows is what we're picking up, or the variation in the shock, is much greater than the variation in the sensitivity, because the same shock predicts realized volatility sort of along the entire bond market, and to roughly similar magnitudes too. Okay, so we're really picking up the monetary policy shock. Check the time here. It's like 10 minutes. Is that about right?
Yeah.
Okay. So effectively, we're going to do I'm going to talk about two more things until the end. The first is the formation and resolution of FOMC uncertainty, and the second will be event risk premium. So Luca and Monk identify these very strong pre-FOMC drifts in equities. So I think we've all seen this picture. At least for me, when I saw this, I thought this can't be right. It's just too big and it's too strong. And maybe because of that, in fact, it's attenuated post-publication. So we haven't seen effects of these magnitudes more recently. I think in response to this, there's new theories. So a paper by Jun Pan and co-authors, and another sequence of papers, Henjiai, Bansal and co-authors, arguing that the pre-FOMC drift, this drift, is in fact due to an ex-ante resolution of FOMC event risk. So if you think of our parameter sigma FOMC, that thing's kind of going down into the FOMC. And the argument for that is market participants are able to get information that allow them to sort of pin that thing down. And there was more uncertainty, and as it gets resolved downward, equity prices go up. And the standard test for this is you look at the VIX, maybe the 30-day VIX, maybe the 9-day VIX, and essentially look at the decline in this into the FOMC announcement. Okay, that's one thing, sort of preliminary test on this. Now, this is problematic due to the periodicity that I mentioned before. We know that longer dated implied vol indexes go down basically every week from Monday to Wednesday. So, and they go up over the weekend also. So if you see them go down, that's not anything about uncertainty resolution. That's just due to the inherent biases of calculating, attempting to calculate a constant maturity index when you're moving through time periods that have different volatilities. Okay, and so we need measures purged of this periodicity, and those are going to be our FOMC event risk measures. Okay, so what we're going to do to look at this is we are going to look at FOMC event risk at just prior to the announcement, and then go back in time. An hour, 2 hours, a day, 2 days, and so on back in time. Okay, and if there is an early resolution of uncertainty, what we should see is a declining, on average, event risk estimate for the FOMC. Okay, and again, what's nice about our approach is we don't need crude proxies like the 9-day VIX or something else to back out the effect. We're estimating the precise parameter that these models are modeling the time variation of. Okay, so this is what we get. I want to show you first what we got in a prior version of the paper before we accounted for periodicity. And then I'm going to show you how it changes once we account to periodicity. Here's what we had before. Okay, the solid black line is the average FOMC risk, event risk, in the 2 days prior to an FOMC announcement. So think from Monday to Tuesday to Wednesday. Okay, and what you see is this declining pattern. Okay, sometimes it goes up, most of the time it goes down. Okay, and the magnitudes of the decline are quite significant. Okay, so it ended up at roughly 0.88 basis points over here, but it started at about 1.2, so almost a 50% decline over the 2 days. Okay, and that would be strongly consistent with evidence for resolution of uncertainty. Now, the problem is over our period, the sample, we didn't have a strong FOMC drift. So once we account for periodicity, this effect goes away to a large extent. So now if you see the solid black line, that is the effect, the average estimate of FOMC uncertainty accounting for periodicity. And we have some referees out there, maybe sitting in the group here, who pushed us to do this, and that was a very important thing. We thought it was irrelevant, and it took us a lot of pain and suffering to figure out how to do this, but it's there, it's important. There is still some variation. Some announcements it goes up, some announcement goes down, but at least for our sample period, 2012 onward, the effect isn't really there. So if you can see here, it's almost flat. And again, this is due to this. If you're looking back in time at the evolution of option prices, 2 and 1 DTE options, these things are going down through time. And that polluted our prior estimates of uncertainty. Okay, so we now think that there, at least for this sample, there was not significant resolution of ex-ante FOMC uncertainty in the days prior to the meeting. And that's also reflected by a lack of FOMC drift over this period of time. So that sort of fits nicely. I just saw this in a JP Morgan equity report. They were documenting for the election that just was resolved yesterday that we had a declining estimates. These are 15 days, 10 days, and 5 days before the election. Okay, now we saw the opposite in 2020. I don't think this is due to periodicity, but certainly I think increasingly as predictable events become so important, and now we have the tools via options to analyze them, we're going to be able to start seeing, or we're going to be able we're going to see more of these calculations done because we're really interested in part in how this uncertainty gets resolved over time. Okay, I want to talk just briefly about one more thing, which are FOMC event risk premiums. We're going to cleanly measure these. We've done them in a number of different ways, but mainly looking at straddle returns across the FOMC. Okay, buy calls and puts, sell calls and puts after the event, and see what happens. And what we find is a very strong evidence for an FOMC event risk premium. Q vol is higher than P vol, and it's really big. Okay, so it's highly statistically significant. It's more significant in narrow windows because, again, as you go to longer windows, you're adding in more diffusive volatility. So this is kind of exactly the statistical significance generally goes down, which is exactly what we would expect. But the narrow window event variance risk premiums are large. They're also robust. Worried about time of the day effects or periodicity effects, we also control for time of the day, day of the week, and we compare to other risk premium, variance risk premiums, things like overnight and weekend risk premiums. And the FOMC risk premium is always there, and it's in fact stronger than the other variance risk premiums that we document. And I think that's just because it's a discrete event, and it is very important. Mindful of time, it's 1:19. We do a bunch of other things in the paper. We're currently updating a lot of things. And I just want to leave you with one picture, and then we can move to questions. So you can do our procedure, works perfectly well on other macro announcements, and we've done it for CPI, core CPI, GDP, and payrolls. And you see similar effects, although magnitudes are different. And interestingly, we see basically no variance risk premium, certainly for the inflation and GDP numbers, maybe a variance risk premium for payrolls, but much smaller, which begs the question of sort of what's different about the FOMC. They're all predictable events with jump risk. Why do we see a much larger variance risk premium for the FOMC? I think I have a good explanation, which I can talk about if people are interested in, but in the interest of ending on time, I will stop there at 1:20.
Excellent timing. Thank you, Michael. So on this note, if you have questions for Mike, please unmute yourself and jump in. While you're warming up, I left one unanswered in the chat. Half question, half comment. Did you look at all at the minutes? So it's Valery Polkovnichenko was asking about the minutes being released during trading hours, right? Does this constitute some event risk? Is there anything to learn from those?
So we have not looked at that. When extracting these out, at some level, if you think of what goes on in the world, there's lots of little events. Some of them are predictable, some of them are unpredictable. We haven't looked specifically at that. We have looked at Jackson Hole, the speech given by the Fed chairman, which is, if I recall, on the order of magnitude similar to an FOMC event. So markets are expecting as much information there. We haven't looked for it. I think it'll be there. Certainly, if you think of, when I see option traders, for instance, at banks, they have an economic calendar and they're pricing all these events. And certainly FOMC minutes, I would think, are an event that's significant enough to warrant some effect. We haven't looked at that one yet. We were more focused on the major macro events, which, if you think of, there's a lot of papers looking at the realized vol of equities, and they sort of rank events, usually FOMCs at the top, payrolls, inflation, and so on. And we sort of took the top handful of those events to analyze.
Makes sense.
Yeah, there is also another question in the chat about how the estimation results are affected by the model set. And you have considered a lot of factors, jump, stock volatility, but perhaps there are still other factors playing a role, for example, volatility. So this is from Ronan Ufu.
Yeah, so we have looked at a lot of other effects. The grid at Columbia is burning night and day as we calibrate models. We mostly focused on other jump distributions, so both for the crash risks and for the announcement risks, non-normal jump distributions. So think of mixtures of double exponentials and things like that, and all of our effects are robust to that. And it doesn't really affect it. That we're able to, you think of our current estimates are effectively the second moment of the jump, whether it's normal or non-normal, you get roughly the same effects. I don't think additional stochastic factors will have much of an impact. So if we think of specifying a multi-factor stochastic volatility model, sort of the first flavor of that would be there's a short-term vol factor and a long-term vol factor. Long-term vol factor is not going to affect anything here because it's sort of mean reverting at too slowly of a frequency. If there were other factors that were moving around at sort of highly correlated to FOMC risk, that would be that would affect it. But in our view, that's exactly what the FOMC effects are picking up. So we've spent a lot of time calibrating other models, and we haven't seen anything that changes our estimates substantively. But we haven't gone to 3 or 4 factor SV models to do that. But provided it's not moving around predictably at high frequencies, I don't think it's going to have an effect.
Yeah, I think I made this comment before, but I kind of repeat it. So I think you developed this very nice tool, and now we even after accounting for seasonality, we're even more refined. But it would be really great to have some kind of macro application or whatever, even if in a follow-up paper, because it's really a tool. FOMC is mostly used by macro people, so maybe we can finally teach macro people maybe change their beliefs about some whatever they believe about FOMC through this.
Yeah, and it's certainly something we've thought about. I think the problem is that the main thing that macro people like to do with these shocks is stick them into vector autoregressions. And the problem is we have a pretty short sample. So if we're looking at a typical quarterly macro, a quarterly VAR, we have roughly 10 years of estimates where we have enough maturity so we can get good estimates. That's going to be 40 observations in the VAR, but it's certainly something we're thinking about and trying to analyze where we might be able to do this. Trying to see if I left it in here. We've created a macro volatility index also, which effectively at each point in time looks forward at all the macro announcements. And now that we have very rich term structures, we can back out estimates of just the macro event risk components forward looking. And then we calculate an index. So think of this as a forward-looking macro event risk index. So mixing FOMC, inflation, GDP, jobs, those kind of things. And this is what you get from that. And it's not that correlated with other common indices that macro people use, like the Baker-Bloom index. Once we've figured out all the details of estimating this, and including a lot of pain and suffering recently working on periodicity, I think that's the next step. We do have, I would say, a follow-up paper looking at 1 DTE options around, in particular, macro announcements, and we do see some interesting things there. But it's sort of at the top of the connecting more closely with the macro literatures on the top of the list.
Mike, Steve Figlewski here. I really like your paper. You did a tremendous amount of stuff in it. And, I'm going to have to read it very carefully. If possible, I've got 2 questions. One is quite simple, and the one is a little bit more to it. The first one is simply that there's 8 meetings a year. 4 of them correspond to the quarterly expirations of the S&P futures, and those are really big ones. And the off meetings don't seem to perhaps have the same impact. So that's my first question. But let me get the second one out first so you could decide what you're more interested in talking about. And that has to do with expectations, let's say uncertainty versus volatility. That when you're coming up to a meeting like we saw back in 2017, 18, we knew already the Fed wasn't going to do anything. right? So our uncertainty was quite low at that point. Other times, uncertainty may be really high, but it doesn't automatically translate into volatility in stock prices. All right, we see this a lot, that times when, we have no idea what's going to happen in the world. Nevertheless, because the flow of information isn't very fast, there's not a whole lot of volatility to move stock prices around, even though we may be very uncertain about what's going to happen in 3 months. So that's kind of my second question, that did you may have answered this already, but did you make any adjustment for what people were expecting the possibilities that they could happen at the
Yeah,
time?
so, to the first one, the question about, with all these extra maturities now with the daily options, whether it's a quarterly or non-quarterly, I don't think makes a difference because, it's not the standard Friday, either monthly or quarterly option expiration anymore. We have Monday, Tuesday, Wednesday, Thursday, Friday expiration. So starting certainly in the first part of our sample, we have fewer, but I don't know of any sort of time variation effect related to sort of standard expiration cycles. Think longer term expiration cycles.
Well,
To
I
the
would think
second,
you'd expect greater volatility for the quarterlies.
um,
Not volume, not volatility. A lot greater
Yes.
volume for the quarterlies.
yeah, although I think with the trading volumes in these short dated options now, I think that may have even, I'd have to look, but it certainly
Right.
is attenuated. It may have flipped even given that, there's so much activity trading these very short dated options. To your question about uncertainty versus sort of volatility, I think that's exactly true. And we see that, let me go back and just show you the picture we had of the time variation of these guys. During COVID was a period of great macroeconomic uncertainty. We saw very relatively low FOMC risk. So, you can see here, 50 basis points in excess volatility. Effectively, that's what's saying, on the afternoon of the FOMC. There's other times here where it's over 2% excess volatility. We unfortunately right now can't separate those two because we're estimating kind of the sensitivity of markets to a shock times the variance of the shock. One thing we're thinking about is as you look into other markets, and certainly as additional maturities are added, it'd be great if we could repeat this exercise for FX, for bond markets, for individual stocks, where we might be able to extract out the shock from the sensitivity to the shock across different assets. And so that's something we've thought about doing. I don't know if we quite have the data to do it yet, but that would be, I think, a really interesting thing because one of the things, I think a general question is it that the FOMC is riskier, or is it that there's periods of time where market participants are just more sensitive or valuations are more sensitive to the same size shock? So, if you think in a basic asset pricing model, when P ratios are really high, prices might be more sensitive to a given, interest rate shock than when P ratios are really low. And so that time varying sensitivity, I think, is certainly something that's probably in the data. As things stand, we don't have a way of estimating, but it's sort of high on our list of things we'd like to do. And once we're done with this, I think we'll sort of look across different assets and maybe we could use a richer cross section to pull out the common component, which would be the FOMC shock, the pure macro shock, and then we could, if once we had that, we could identify both the sensitivity of a specific market to that shock. So we'd have the equity market sensitivity, the bond market sensitivity, and then the individual shock. And then that to me would be really interesting if you see those things moving around at different frequencies, where there's periods of time where equities are more sensitive to a given shock than, say, bonds are. And by the way, Steve, it's nice to see you.
Likewise.
Anyone else has a question for Mike? All good then. Well, Mike, thank you very much for your presentation. Very insightful. And yeah, I imagine that was a lot of work. So thank you for coming. Hopefully we'll see you in 2 weeks, even though it might conflict with your regular seminars. In 2 weeks, we're having Christopher Schwartz from UC Irvine, who's going to talk to us about retail option trading. And so I hope to see all of you back in 2 weeks. Thank you for being here today, and maybe we'll see some of you next week in Chicago.